Today, I'm going to talk about my reflections about my investment journey as a Singaporean since I started investing 8 years ago. I recently attended the Singapore Exchange Annual General Meeting on 09 October and spoke with senior leaders. As someone who has treated stocks as ownerships of businesses, investing in stocks and funds for the past 8 years, and attended AGMs of different listed companies over the years, this is an exciting moment for me. These are some of the learning points that was discussed in the Singapore Exchange Annual General Meeting, and I hope to share them with you. Number 1. The importance of diversification. I've invested in the Singapore Exchange through my CPF Ordinary Account funds around the start of 2020 COVID lockdown. Since then, I've seen the growth of our Singapore Exchange, whereby the senior management transformed the Singapore Stock Exchange to a diversified global exchange with multiple asset classes and a global franchise that we can be proud of. Seasoned investors over the past 10 years will have known about the value trap situation in Singapore. Many companies in the property sector and small cap stocks are trading below the book value for many years. And some of the best performing companies in the world have chosen to raise capital at least in exchanges beyond Singapore. This has led to many investors leaving the Singapore Exchange to invest in foreign markets. For investors that fail to diversify beyond the shores of the local market and invest in the better stocks and funds overseas, this will have to lead to a significant opportunity cost. No one can be certain whether the Singapore stock market can continue its rally up this year. What is certain is that diversification isn't just for retail investors. Business owners and senior management believe in it too, and diversify globally to grow their assets and wealth. Number 2, the psychology of money. One interesting insight that the management mentioned is that the exchange serves all sorts of investors. Some are so risk-averse that they cannot accept anything beyond government bonds, while others use different platforms to invest in financial assets and alternative assets. It is crucial for individual investors to choose the right investment platform and strategy that suits their risk appetite. One important insight is that major indices nowadays are market capitalization weighted, whereby they consist of mainly large cap stocks, and often the larger the company, the larger the position sizing. Oftentimes, these stocks in the index are priced higher than the rest of the market. By investing in such a product, essentially you are buying companies without researching in the quality and the valuation of the businesses. Many index funds also carry concentration risk, and that is why professional investment managers and platforms have their value. Also, throughout my line of work and meeting with many people through social media, TikTok, WeChat and other ways, I noted that every individual has a different psychology, philosophy and attitudes towards money. Senior people who have gone through recessions and retrenchments with families to feed are much more risk-averse. Or younger investors who have not experienced any financial crisis in recent years are often misguided on the actual long-term returns of stocks in the long run. One thing is certain for everyone: if one does not know their true risk appetite and does not choose the right investment philosophy or strategy, will be setting up themselves for failure. They will boast themselves as fund managers when the stock market goes up, and pride themselves as risk managers and cutting loss when the market goes down. The opportunity cost of mistakes and compounding them can be costly, and often than not, timing the market is better than timing the market. Number 3, choosing the right partner to work with. One of the questions I posed to the senior management at the annual general meeting is the strategy they decided to pursue for the sake of growth. Seasoned investors in Singapore market when gone through the XGX Bursa CLOB linkage issue in the 2000s, whereby our business partners shut down the trading engage and led to severe losses for Singapore investors. Following the lesson about counterparty risk, the Singapore Exchange have learned how to manage it better. Instead of following the Stock Connect and Bond Connect model in China and Hong Kong market, the Singapore Exchange decided to list products such as Singapore Depository Receipts, ETF product links with the Shanghai and Shenzhen Exchange, and a mutual offset agreement with GME for derivatives trading. In business and in life, It is important to choose your partners wisely. They can either be your sail or your anchor in life. Choosing your honest and trusted business partner will be one of the most important decisions you will make in your entire life. Want to kickstart your investment journey? Want to let the magic of compounding grow your wealth while you sleep well at night? Work with your trusted financial advisor. Now,